Again, hi to everybody as they continue logging in. We'll just be with you in a few minutes. Right, it's ticked out to a couple of minutes after 12. I think we may as well get started, Shamubeel, yeah?
Yep, absolutely.
And so once again, to those of you who have joined very recently, I'm Andrew Lance, Chief Investment Officer at Simplicity. With me is Shamubeel Eaqub, who is our Chief Economist. We've got a few slides that we will go through. Shamubeel's put together just to give, I think, some context to where we're at. Obviously, as everybody will be aware, there's been a fair amount of moves in financial markets over the last few days, thanks to the announcement of tariffs by Donald Trump last week on the 2nd of April. So without further ado, Shamubeel, I'll hand over to you.
Thanks, Andrew. Hey, and we'll have plenty of time for questions afterwards, so please put them in the Q&A or the chat bit there and also in YouTube. If we're scheduled for 1 hour, but if we go over, we're happy to hang around for a bit longer to answer your questions. So I thought I'd just give you a little bit of context around what's going on, what the consequences are for the economy and financial markets, and then give you some of context again around what we're doing on I guess how we invest and where your money is invested, because we get those questions quite regularly. So let's get into it. So there's a bit of a disclaimer here because I think we always go through this. It's quite important that you understand that this is general information. It's not for your personal financial situation. There's quite a lot of detail on our website around our investment fund schemes and our sort of the product disclosures that are possible, that are there. Have a look at the resources that we have around how we do our ethical investments and those kinds of things, because I'll talk about it today, but I won't have time to get into a whole lot of detail. So that information is available on the website, and please have a look at it if you're interested. So where are we at? So the big kind of, I guess, news was the tariff announcements that were made on the 2nd of April, and it was pretty big. So if you look at the picture on the left-hand side, Trump announced widespread tariffs on countries around the world, some very large tariffs on countries that we trade with. So the current proposed tariff rate in the US is 22 point something percent. It's the highest since the early 1900s. So it's a really, really big change from everything that we've been used to in the last 80 years. If you look on the right-hand side, it gives you a bit of a sense of just how that has affected how we understand the economy. That's a measure of policy uncertainty in the US, and you can see how quickly that has spiked over the course of the last month or so, but really since Trump took office. And the current level of uncertainty is similar to what we had experienced when COVID first hit. So it is a really unusual time in history, and that's why markets are just so scared right now, because there's a huge amount of uncertainty and people don't know how to make sense of it. Now, I titled my slide here, Will the Tariffs Last? And the reason why I asked that, because Trump has been very inconsistent in the way that he's pursued policies. But there is a real fear amongst people that I speak to that these tariffs, at least in some shape or form, is here to stay. And that means it will cause real economic impact, and it will cause some damage along the way. One of the kind of most immediate consequences of increasing tariffs is that it raises the cost of imports for Americans. And so you can see that picture on the left-hand side. There's the inflation rate of import prices in the US, and you can see that it's very unusual for prices to increase by 20% in a given year. And that's kind of what America is going to do with the tariffs. Almost immediately and by choice, they're going to increase the price of imports very sharply. Previously, when we've had those kinds of increases in input prices, consumer price inflation in the US has been 5 to 6%. So we might be looking at a really big inflation shock, which reduces people's incomes and their ability to spend, and thus the wider economy. And so that's really the big risk that we're seeing immediately in the US. The secondary risk is the countries that trade with the US are affected by these tariffs. So in New Zealand, we've been hit with a 10% tariff, and you can kind of see the commodities there. We export a lot with the US on the left-hand side picture. It's a busy picture, but have a look at the slides later. We'll share them with you if you're interested. But you can see that things like meat, we export a lot of meat to the US, and about a third of it goes to the US. So those tariffs will have an effect. On the right-hand side is the reason why I'm more concerned about these tariffs on the global economy and our trading partners. If I look at our top 20 trading partners, the new tariffs or the total tariffs on these markets is 46%. So this is China, Vietnam, and pretty much most of Asia has been hit really, really hard with these new tariffs. So there is a secondary effect for New Zealand where our trading partners are affected. They consume less of our products, demand less of our stuff, and that has a flow-on second-hand effect on New Zealand. So there is a big question, will they last? But we know that as a result, we'll have an immediate increase in input prices for the US. We're going to see retaliatory tariff increases in other countries. So we might see a period of uncertainty and uncertain economic effects as a result of it. The American view is that with these tariffs, we're going to have reduced demand for imports, and thus we're going to have an increase in domestic production, that this will be the revival of manufacturing in the US. Now, it may or may not happen. The history, if we look at the last few times we've tried tariff wars, particularly in the early 1900s, was it didn't actually work very well. It just made everybody poorer along the way. So the base case that I've taken as an economist is expect lots of disruption when it comes to trade, both for us directly, but also second-hand effects through the countries that we trade with. There'll be quite a lot of diversion of trade. So countries that are less affected than others. So for example, we have 10%, somebody else who export meat might have 40%, and we might export more than them, but it doesn't mean the world is going to consume more meat. We should assume that because overall demand will be less, there will be some effect on the economic activity and job losses. For those countries who impose tariffs, they will experience higher inflation. But because the exporters are going to be so desperate to get their products away, we're probably going to experience, relatively speaking, lower price in the rest of the world. So what does it mean for New Zealand? I think three things. One, the Reserve Bank should continue with rate cuts. We can't be sitting aside while there is a huge amount of financial and economic uncertainty. This is what monetary policy headroom is for. They should be using it. The second is around fiscal stimulus. The government is currently pursuing austerity in the middle of what is clearly an absolute breakdown in financial markets globally. Is not the time to be pursuing austerity. We should see the government really pushing ahead on infrastructure investments that they have slowed down. And I think there is a policy choice here as well around there's a really good window of opportunity for New Zealand to really lean into our like-minded countries and ask for better trade deals, more closer cooperation, and even less barriers to trade than we have now. So there will be a secondary parallel club that will arise out of this, this tariff war that has taken place. So New Zealand has a real opportunity here to actually deepen those long-term strengths that New Zealand has benefited from. And so this is a picture that Andrew talked about right at the beginning about the impact on financial markets. You can see on the left-hand side, that's financial markets just over the course of this year to date. That dark green line is the US, and you can see the FTSE World in the orange line there. And on the right-hand side is a slightly longer-term picture because I think it's really easy to look at short-term pictures and get quite worried. But if you look at the right side picture, you can see that yes, markets rise and fall, and this has been a particularly sharp, quick fall. But you can also see that over the longer term, markets have been returning some very strong returns over time. Even though we've seen uncertainty spike, we haven't seen major shifts in interest rates. You can see that picture on the left-hand side, so that's really important. That's one of the ways that portfolios can get stability. So if you have a balanced portfolio, for example, that stability in bond markets will have at least offset or moderated some of those weaknesses we've seen in financial markets. And on the right-hand side, you can see the New Zealand dollar has been depreciating over the course of the last year or so.
The nearest fire exit. Evacuate the building using the nearest fire exit.
Oh no, that doesn't sound good. We'll keep going. So you can see on the right-hand side, the exchange rate has really eased off, and that's provided a bit of a buffer for all of us. So how does it affect our investments? And I just want to kind of really explain this very briefly, because as a Simplicity member myself, this is one of those things that I think is hard to kind of get your head around, because some of the documents can sometimes be a bit, I guess, onerous to read through. So here's a little bit of a way that let me explain how we do our investments at Simplicity and how we put it into practice. So on the left-hand side is roughly our kind of philosophy of how we invest. So really the big decision we make is around asset allocation. That is how much of stocks, bonds, and alternatives we have, how much hedging of the New Zealand dollar do we do. And our asset allocation is really, really simple. We essentially take an average of all the KiwiSavers in New Zealand, so that what we're doing is we're providing kind of the normal asset allocation of how portfolios are put together in New Zealand KiwiSaver landscape. We apply a ethical screen, and that's really an exclusion list. So there's a bunch of ways we do it around revenue thresholds, et cetera, et cetera. That's in our responsible investment policy. But essentially what we do is we look at the indexes that we invest in, and we exclude certain types of businesses that we think are not ethical. And we try and do this with low fees. We buy and sell investments to track the screen index within that asset allocation. And how we do is predominantly passive. Is we're not making an active position on stocks. What we're doing is essentially going, you can, in a balanced portfolio, for example, you have this much equities, this much hedging, this much bonds, etc. And we track these diversified indices because they're quite big. I'll show you a picture afterwards. And what we do is we buy and sell those direct entities of bonds and stocks. We keep this cost really low by working with global firms who are doing this for us at a relatively low cost, because they have economies of scale, and we try and pass those on to our members. So I just wanted to show you just a little bit of a picture. And this is a bit of a picture of how the asset allocation looks like across our how it works in terms of our different asset allocations. And you can see that on the left-hand side is an example of the balanced fund. And you can see that what we've got there is, the dark green line is the unhedged global share fund, followed by the hedged share fund. Then there is the New Zealand stocks, and then you've got the bonds that are global, that are hedged, the ones that are unhedged, et cetera, et cetera. So you get a sense of just what it looks like when we're putting together a portfolio, one of these fund types, is we're doing a mix and match of those different indices or different groups, asset classes that we hold. This gives you a little bit of a picture in terms of how we do our diversified asset classes. So this is our Simplicity Investment Fund for unhedged global share. And you can see what the allocation's like. We had about 73% in the US, so you're absolutely correct. We had some questions on this last time, that we are quite exposed to the US because it's one of the biggest, deepest financial markets. And then on the right-hand side, you can see some of the other countries that we invest in because of the way that those indices are put together. This picture here is just a follow-on from the one before, and it just breaks it down into those individual stocks within those markets. So you can see where the diversification sits in terms of how we have selected this market. So if we're investing in the US, some of those very big stocks on the left-hand side will be those very large companies like the Facebooks and Teslas and those kinds of things. And then there's a whole bunch of other smaller companies that are invested here. And I just want to give you a little bit of a sense of how it performed, what the impact is of that asset allocation. So on the left-hand side is a picture of 3-month returns in the first 3 months of this year. So it's a little bit out of date. And then you can see that on the right-hand side is how those different types of asset classes are held in our balanced portfolio. So you can see that while in the first 3 months of this year, we had some pretty big falls in financial markets, the balanced fund fell about 2.5%. So that relative growth or stability in the bonds and cash really offset some of that weakness that we had seen in equities. That's how it's meant to work. So it depends on your risk profile and what you invest in, and that really has an effect on how you're protected from downsides, but also how much of the upside you can benefit from. And so from my perspective, I think there are three kind of big choices that we all make as KiwiSaver participants. The first is around what scheme or provider do you choose? So Simplicity, or whether it's Simplicity or another provider, you can choose, but you can only be a member of one scheme at a time. And within that, you get to choose your fund type, whether it's growth or balanced, based on your situation and risk tolerance. And the final, I guess, decision we need to make is around how much we contribute. Of course, there is the 3% contribution from employers or more for some, plus 3% or more that you can contribute given your kind of investment goals. So these are kind of the big choices that we make, and those financial market movements are kind of outside of our control. And I just want to take you through some of the background and context, because we've had a lot of engagement in the last few days around, I think, people just trying to make sense of what's happening in the world and how we can do it. When I kind of look at the key points that I want to make today, first is around, we're just dealing with this period of extraordinary uncertainty. We just don't know for sure what's going to happen, and that's fine. Because we can't predict what's going to happen, we just need to think about what are the things that we can control. And the uncertainty is really affecting financial markets. And that's why that's the main channel that we're seeing the effect on KiwiSavers. And we really have to ask ourselves, what are the things we can control? What are the decisions we can make on, and make sure that those are right for us? And I think that's probably the bit that's really important for all of us to think about is, are you making the right decisions for you today and for the long term? And it's really important that you get good advice if you're unsure, because these are big decisions, markets are uncertain, and big decisions right now can have a big effect on you. So just make sure you take it in a considered and patient way, because market uncertainties come and go. But these decisions that we make are really important that they're right for you both today and into the future. So there's a whole bunch of stuff around our disclosures. You'll have access to all of that. I know that my team members have been evacuated from the building because of a fire alarm. So what I'll do is I'll start getting into the questions now. So the first question is from Peter. He said, according to Where's My Money section of the fund allocations and Simplicity, growth, high growth, and hedged, unhedged global share funds have very high proportion of US stocks, 50 to 75%, compared to other international markets. Historically, this would make sense for long-term performance, but are we entering a new paradigm where overexposure to US shares could be bad for Kiwi holders? Will Simplicity look at other indexes that weight more heavily in international markets as an option to diversify away from the USA? Thanks, Peter. Peter, it's a really good question. And right now, we're not making any drastic decisions on what we do with our asset allocations. So we will keep watching this really, really closely to make sure that we are exposed to the right possible things. As you know, the history of financial markets is that when you get big drops, quite often they will be followed by big increases. But we never know when that will happen and how long that might take. So trying to make a big switch right now might lock in those losses that we have made so far. And it's not clear to me that that's necessarily the right thing to do. It looks like maybe some of you couldn't see the screens. I'm sorry about that. Obviously, when the fire alarm happened, something might have gone wrong. So I will share those slides with you later. Just drop us an email or a message. So we had a question from Ryan that said, from Justin on YouTube. So New Zealand's biggest risk is the impact on others we trade with outside the US rather than our trade with the US directly. The answer is yes, that's correct. So while we are exposed to the US, the tariffs that have been imposed on New Zealand is relatively low. So because we've been hit with a 10% tariff, while other countries have been hit with much larger rates, relatively speaking, New Zealand is a little bit protected. So at least for the short term, I'm expecting that our trade will be fairly resilient. If anything, we might get a little bit of a lift. But the big risk for us is that we are quite reliant on many of these other countries, like China, like much of Asia, that are also quite reliant on the US. Those big tariffs on those countries will have a second-hand effect on us that I think is going to be really quite a lot bigger than the direct effect. So it is very much the case of thinking about what are the channels of effect of this tariff war on New Zealand. The first is around, I guess, the financial markets on KiwiSaver. The second is around the direct effect on our exports with the US. And the third effect is the indirect effect via the impact those tariffs have on our trading partners. That was the one that's probably going to take a little bit of time to come through, but is one that's actually really, really powerful and important. From an anonymous question, with the USA keen to take over Canada and Greenland, with Trump supporting Putin's goal with Ukraine, and the strong possibility of China finally gaining control of Taiwan during 2025, how will these events impact the global markets? Well, it's a big question, and of course, none of us can predict financial markets. It's hard to know what will happen. And we don't know if all those risks that you have identified will in fact take place, or when they might take place if that happens. Given these uncertainties, I think the real issue here is that we don't know for sure what will happen in terms of these risks. And it's this uncertainty that is really affecting financial markets at the moment. So we're in a really challenging position where markets are not necessarily dealing with just what has been announced, which is the tariffs immediately, but also this wider uncertainty that we talked about in our last member update, which is around just the tensions around geopolitics and that wider story. So there is quite a lot of, I guess, uncertainty still to work through. And if and when those things happen, financial markets will digest them as and how they will. But generally speaking, when there is geopolitical conflict, we tend to see lots of risk appetite being reduced. And as a result, that impact tends to be that financial markets tend to get hit. Darren's question was, given the heavy weighting of US equities in most KiwiSaver growth portfolios, do you anticipate reallocating away from the US if trade tensions escalate? So at the moment, what will happen is if the US market is being hit more than other places, which is what's happening, we might see an automatic kind of rebalancing of portfolios. But again, we haven't yet made a deliberate decision to shift the way that we invest. So these asset allocation decisions really do have to be taken in slow time and over longer term, because how we invest will have a big impact for many decades to come. So we're not yet ready to divest away from the US. It is still one of the biggest, wealthiest economies in the world. Some might argue that maybe there is some risk to it, but the reality is that it is still quite an important part of the global economy and for our trade and for financial markets. So we also had a question from Jan, can we divest away from the US? Well, not immediately with the funds that we offer, mainly because, again, it remains one of the biggest financial markets and we are exposed to it. An anonymous question was, should we be buying the dip? I guess that's really what happens when you continue to contribute into your KiwiSaver. Because you're constantly adding money to your KiwiSaver accounts, it means that regardless of what markets are doing, you're always buying. So the dollar cost averaging that we always talk about. And I think that's essentially what we're doing is we're saying, while the market is weak, you keep buying those things because, as Sam always says, when the markets fall, all the shares are on sale. So that is really what is happening in practice in the way that we run KiwiSaver is because we've constantly got money to invest. We are adding that money into the new money into buying these broad allocation of companies and bonds every day. There was a question from Tony. Could New Zealand meat exporters benefit because Canada and Mexico, who are big exporters of meat to the US, have tariffs higher than our 10%? Really good question, Tony. And the answer is yes, at the margin, we might benefit. The real difficulty here is this: the type of meat that we export to the US is a little bit different from what they export. So New Zealand and Australia, by and large, export mince meat essentially for burgers. So our meat tends to be quite lean. It's very specialized for manufacturing processes. So a lot of the other meat that's produced in the US and imported in the US is probably more the juicy steaks rather than the mince. So we're not necessarily operating in exactly the same type of products. So it might be that at the margin it is good for us, but also it's unlikely that either the US or us could have shifted away quickly because there's not that many people who buy that particular type of meat that we export. A question from Mary. I've heard Sam Stubbs saying in interviews that it will be possible to split Simplicity KiwiSaver across different funds. Is that still in the works, and when will it happen? Look, I don't know for sure, so I'm a little bit of a loss because my colleague Andrew's not here at the moment. But last time we had this conversation, I think we had a similar question, and the answer was, we're trying to do this and it's not quite there. But watch this space. We're definitely working on it to make sure that you can split some of your investments across these different things. Also, of course, as you know, that not all of your money needs to be in KiwiSaver. You might have some of your money saved in investment funds. And when you're using investment funds for those non-KiwiSaver savings, you can split them across different types of funds and thus create your own kind of risk allocations. A question from Anonymous. What would you expect, want to be seeing from New Zealand's trade negotiators in the weeks and months ahead, not only in their engagement with the US, but with other like-minded partners? Excellent question. I guess that's kind of the big opportunity and big risk that's in front of us. So what's happening with the trade wars, I guess, is the immediate risk is that we've had the tariffs that have been imposed on us and our trading partners. That's fine. And we should engage with the US on that basis to go, what can we do to negotiate those tariffs down or to have them removed entirely? That's one step. But the much more important and I think much more impactful thing that we can do in this time period is how can we partner or how can we reach better agreements with other countries around the world? So there are a lot of countries around the world who are still believers in free trade. They still believe that tariffs do damage to global economy and don't create any winners out of it. Now, if that is the case, then it's a really good time for us to be negotiating with countries like Canada, UK, Europe, Japan, China, Korea, you name it. There is a wide range of countries who have been hit very hard by this trade war, who will be much more open as a result to negotiate with a collection of countries in parallel. And I think there's a real opportunity for New Zealand to play a strong part in that. So I had a bunch of interviews with media over the course of the weekend on exactly that topic, mainly because it's such an opportunity, right? If you think about that window of opportunity that has been opened up, because the world is uncertain, because the traditional leader of the global order of free trade led by the US is now being pulled away, everybody's looking for an alternative. And I think we really can make sure that New Zealand has a role to play in that. So we have exceptional foreign trade officials who are able to do this on our behalf. They have very strong relationships, and I think it's really important that we see them doing that as quickly as possible. But really, that focus and energy, I think, should be on our other trading partners outside of the US, because that's where the future opportunities will come from. A question from Anonymous. What can Simplicity do to respond to this uncertainty, i.e. safeguard member investments? Well, the way that we look after you is make sure that you have exposure to the right kind of investments at the lowest cost. And markets will go up and down. We have no control over that. What we can do is make sure there is a selection offering of funds that you can invest in that's fit for purpose for your risk and for your personal circumstances. So again, we always talk about this, but it's really important that you get that personalized financial advice so that you are absolutely in the right kind of investment that's right for you. Otherwise, it's very difficult for us to be able to provide personalized advice to you, because that's not what the business we're in. So our advice is, if you're here in KiwiSaver, it's because it's for retirement, it's a long-term investment. What we can do is look after the way that your money is invested at the lowest possible cost in the best possible spread. Markets will come and go, but because you'll contribute, because you'll be here through the thick and thin, because it's time in the market rather than timing the market, you will come out better off in the end. Question from Ellen. Trump's goal is to bring manufacturing back to the US. That is a short-term objective, as the companies need to set up, buy machinery, which also incur tariffs, and upskill laborers, some of which are getting deported at the moment. In general, manufacturing counts for lesser than services and tech. What are the long-term financial risks around this? Really good question. And I guess if we take a little bit of a step back of the last kind of 80 years, what we have seen is that many of the rich countries, advanced economies, have seen their manufacturing sectors decline and shrink, and they have gone and set up around the world, particularly in Asia and emerging markets. And the hope and aim of the Trump administration is that because they'll be imposing these tariffs, those manufacturing jobs will come back to the US and it will make America prosperous like it was back in those days. I mean, of course, America is already extremely prosperous. And in fact, it's not really clear to me that going back to manufacturing is going to make them richer. Rather, it will make them poorer. But that's by the by. So the challenge, of course, is that, as the question said, even if they're to have this increase in manufacturing, it's going to take time. It's not going to happen immediately. And what happens in between is that they're going to be hit with these high prices. So people's consumption will be hit, the economy will slow, and it's not really clear the net effect is going to be positive. In fact, that's what the literature shows of all the studies of the 1900s and before. We're not going to really see any kind of net positive effect. So the most likely effect is that we're going to see higher inflation in the short term. Manufacturing may or may not come back, but really it's unlikely that we'll see manufacturing coming back in a big way, mainly because manufacturing doesn't happen in the way that it used to in the past, which used to be very kind of short supply chains, very concentrated in particular towns or particular places. Instead, what we used to see, of course, what we see these days is that manufacturing happens across value chains that are spread across countries and vast distances. Because you might get a chip manufactured in Taiwan, but you might get the casing manufactured in Vietnam. It might be manufactured and put together in China before the final product. So, and then consumed in the US or Europe or wherever. So the financial risks is really around, we've kind of got this extraordinary self-defeating economic policy that's being pursued in the US. And it might be quite negative for the economy and as such for financial markets. But it's not a prediction because we don't know what will happen in the midterms. Because if these tariffs are really unpopular, then we might see a really big change in the political course in the US. We might see a change of government in the US in a few years' time. So it's very hard to predict that just because we're seeing something today, that it's going to be a linear course and we can predict what the next course of action will be. So financial markets right now are grappling with that uncertainty. I think we all are. Can we predict what the next sequence of events will be? Absolutely not. I think we've moved into a world that's uncertain. And financial markets hate uncertainty. And I think that's really what we're dealing with is financial markets will probably remain uncertain because of those geopolitical and other risks that we're seeing in the world. So what can we do? The answer is we can't control that. It's high impact, but low control. But what we can do is make sure we're in the right kind of fund and we're making the right kind of contributions and we're buying and selling through thick and thin, right? We keep contributing regularly through the time. And that's always been the kind of the way that long-term investments have worked well. Jan says ethical screening should no longer support Tesla, Amazon, etc. Yeah, so and exactly. So we've got the responsible investment document up on our website. So it's quite rules-based, mainly because when you're running across thousands of businesses and bonds, you want to make sure that it's done in a particular way. So when those thresholds are met, we will exclude those businesses. So including Tesla and other things, as long as it falls in foul of our ethical, responsible investment guidelines and policies, then we will stop investing on those things. So, these things are always extremely difficult, right? Because there's so much judgment involved in terms of what's right for you versus what's right for somebody else. And again, that's why it's really important that we're really transparent about how we make those decisions, because we do have to make it rule-based and it's consistently applied as possible. But there's always an opportunity for us to have a look at that again, and I'll make a note to have a conversation with our responsible investment team. Okay. Anonymous attendee said, on 19th January, USA had low inflation, low interest rates, record share markets, and low unemployment. This Republican's view is a disaster. How can anyone believe that USA production will increase when few workers are unemployed and the government plans to ban many overseas workers? Look, I think it's very much this new economic experiment that we're seeing in the US. You're absolutely right that the US was very much in an exceptional state until recently. It had strong economy, it had low inflation, it had beaten a lot of that stuff. The stock market was going well, record employment, wages were increasing. There was a hell of a lot of good news. And the rest of the world was looking at them with some envy. But What Trump is doing, I think, is very much a strong ideological view that this is what's going to make America great. And whether we agree or disagree doesn't matter, right? Because that's essentially the decision that they're making in the US right now. And it's very easy to try and wish away these kinds of big shifts, but the reality is that there is something that's much deeper that sits underneath it. And that's that political discontent, the social discontent that has been building for many years. So what we're seeing with this new economic experiment, I think, is probably something much deeper, much more deeply rooted around fraying social cohesion in the US and other parts of the world. And it's kind of this lurching towards something else because it's a rejection of the current. It's a really hard one because these periods of big change, like when we're moving from one regime to another, can be really quite powerful and quite difficult because there is no script for what comes next. So I don't know if I have a good answer for your question or statement, but the reality is that what we're seeing, I think, is a new experiment of how to arrange the economy, how to arrange global trade. And we are, in relatively speaking, in uncharted waters because we don't know what will come next. Anton asks, Simplicity under its ethical investing webpage mentions various criteria that you avoid, including anti-corruption. Tesla and especially Elon Musk has shown to be dubious at best, and Musk's involvement with Doge has removed government workers who were investigating his companies. Will Simplicity divest from his business? Andrew has returned at just the right time to answer that question.
I think I caught the end of it, I mean, the answer in simple terms is that our policy and process in regards of all of our investments really is passive, and therefore we follow indices. If a company is in the index and isn't excluded by one of our other policies, then we invest in them, but only, as your slide will have shown that I didn't see, Shamubeel, obviously for any individual company, every exposure is very small.
Darren says, thanks for continuing considering the fire alarm challenge for your colleagues. I think we also lost the slide, so I'm really sorry, people, because I think you didn't get to see the slides that I was meant to show you. We'll share them with the members afterwards, so thanks for being patient. In your opinion, Shamubeel, how significant are these US tariffs likely to be in terms of long-term market impact? Is this more noise or the start of a structural shift investors should be preparing for? Look, I'll ask Andrew to chime in as well, but my view is that it's twofold. Financial markets will work through this uncertainty one way or the other. So it will reprice and then we'll get back on whatever new trajectory it will be on. It's this period of rejigging that's difficult. We don't know for sure what that new stable state of the world looks like. And I don't think it's just tariffs. It's tariffs, trade policy, economic policy, geopolitics, defense. All of those things are being rethought at the moment. So my sense is that if we think about financial markets from that perspective, it's not that they continue to price it permanently and we see a permanent divergence, but it's more that there might be a period of uncertainty that markets have to deal with. Do you have something to add to that, Andrew?
Sorry, I was just reading through a couple of other questions. Not really. No, I think you've covered that perfectly.
A few other questions on Tesla. One person asked, does anyone want to buy a second-hand Tesla? Yes. Not me. I don't want to be making that statement driving around at the moment.
No.
I might just keep asking the questions, Andrew, if that's okay, since I've kind of went on.
Yeah, and interestingly, because I've logged back in, I've only got the last three, so you don't have the history.
Suppose somebody was in the growth fund. Could you explain the impacts to financial performance of that person switching to the balance fund at this time to flee into a safer haven? Really good question. And let me give it a crack and then Andrew can jump in. Essentially, you'll be locking on those losses in markets if you did, and you won't participate in the rebound if and when it happens, if it happens, because the balance fund will be smoothing out both the downs and the ups, whereas the growth fund will be taking advantage of both the downs and the ups. So I'd say you're crystallizing those losses if you switch now, but it might be the right decision for you if your personal circumstances require it.
And that last point is the key. Everybody's personal circumstances are different. Your tolerance for risk may be greater, higher, lower. Your stage of life dictates what type of risk you'd like to take. And so there are so many variables in terms of, exactly as Shamubeel says, switching out of growth into balance after we've already had significant declines might not be the right thing to do. Back in 2020, it was the absolute worst thing to do. But again, at this time could easily be different. It feels rather different at this stage to the sort of COVID reaction, because this is event rather than just what was or turned out to be if you like, a short-term influence from something external. Yeah, as I say, unfortunately, we just can't give personal advice without knowing all of the circumstances of a person's circumstances. Sorry.
An anonymous attendee asks, how do I decide whether to stay in growth or reduce down to balanced or conservative funds? You mentioned not locking in losses. We saw something similar during COVID with big losses that recovered. That's exactly right. And again, I think it's that very personal situation. So make sure that it's right for you, because you do lock in those losses if you're moving into something, but we can't predict what the markets will do. There might be further losses, or it might rebound very strongly. And therein lies the challenge. So we're probably not helping you in terms of make a concrete decision. That's why it's really important you get personalized financial advice on this thing, because it is quite a big decision to make if you're choosing to make a switch at this point in time.
And as Shamubeel, on one of the slides, I know Shamubeel did show, it was that long-term growth in the share markets, which over the last 5-10 years have, on balance, been very positive. This is obviously a short-term sell-off. It may last a while, but fundamentally, the idea is that growth funds that have more investments in shares will outperform balanced funds and conservative funds that have more bonds or more cash, because shares over a long period of time generate the greater returns, and that they're more plugged into the economic growth of countries, whereas interest rates are obviously a lot more static.
Right. So Chris asks, are there any silver linings to the tariff-induced deflationary pressures on prices, such as our imports? The answer is yes, there will be some positives. There are always winners and losers out of these policies. And I think that there are a couple of ways to think about it. The first is we're probably going to see, relatively speaking, a little bit more demand for some of our products that we export to the US, because our tariffs are a bit less than everybody else. But the bigger concern is that because of this high increase in prices, the US consumers might be weaker and they import less. When a country imposes tariffs, the countries that used to export to them quite often will now be desperate to sell their product to somebody else. And that means they will quite often discount or move things on at much more favorable prices. So the global setting for inflation is probably a little bit more favorable, at least in the short term, while that excess manufacturing capacity works its way through. So yes, we'll see a little bit of, I think, a little bit of a boost in terms of import purchasing power. But I'd say net still tariffs are not good for global economy, because essentially what it does is it adds deadweight loss to consumers around the world. And as a result, we're all poorer at the margin. Okay, Matt asks, tariffs and macroeconomics aside, has Tesla as a brand become toxic? Individuals around the world will vote with their feet against many US brands. Can simplicity anticipate that and divert our investments away from them? Question for you, Andrew.
Oh, damn. And I'm afraid it's the same answer as previously. Although, I mean, what will happen is if the US companies, etc., and Tesla's certainly one that's been in the across the tapes a lot over the last 36, 48 hours. If investors begin to move away from those sort of stocks, what will happen is it will reweight our index. So our moves will follow the rest of the world. But I have to say in this, we are a follower. We just don't believe we've got insight that will tell us that to actively pick one stock over another. Our preference is to buy a little bit of everything.
Tony asks, could F&P supply sleep apnea machines from New Zealand rather than from their Mexico factory to lower the tariff burden? They probably could. I just don't know for sure how F&P is managing this risk. I imagine they have been thinking about planning for this for some time. Andrew, I don't know if you followed closely. I haven't looked at Fisher & Paykel Healthcare for a long time in detail.
No, and again, I did see something on one of the pieces of research over the weekend, which suggested Fisher and Paykel are not quite as directly impacted by all this as I thought they were. But no, I don't have anything particular.
Robin asks, should changes in mid to long-term global risks influence an individual's decision to choose lower risk options?
Yeah,
your answer to that.
Yeah, I suppose I'm just trying to think through what the sensible way to answer it. The fact is that it's if you like, it affects everything. So if the risk in equities is increased, then the natural reaction is for them to get sold off to a degree, and that means that you get the opportunity to buy equities at lower prices. If it's probably more to do with their expected returns. I don't really think the change in the risk is going to make a huge amount of difference to where you'd want to be. But if the perception is that returns from equities are not going to be as good as they've been over the last, let's say, 10, 20 years, then possibly that would make some sense. I'm sort of thinking through. Certainly, I mean, from the overall advice, which is not personal advice, is to keep a focus on that long-term objective. So it depends on what stage of life you're at, how soon it is that you're going to want to start drawing down on any of your savings.
Yeah, and I think it goes back to those three options that we all have. It's in KiwiSaver, for example, it's what KiwiSaver you're in, what fund you're in, and how much you contribute. So those are the kinds of big decisions you can make. From my personal perspective, I don't think it changes the way that you think about risks that's appropriate for you, because you would have made the decision based on your personal circumstances and your goals for what you want that retirement savings to be. What we might see as a result of elevated risk is there's more volatility in returns, but it's not clear to me that as a result, we should see expected returns to fall. So it's probably more making sure that you're, again, still in the same question, am I in the right fund for my personal situation? Karen asks, with regard to your comment just now about New Zealand needing to negotiate new trading partners to reduce our reliance on the USA, do you believe our coalition government will actually support this idea? I'm not confident that they will. Well, I think they will, mainly because, funnily enough, it's one of those few areas of politics where there's bipartisan support. New Zealand, regardless of who's in power, has had increasingly deeper ties with the rest of the world. And that's really been led by the public servants rather than the politicians per se. So I'm pretty confident that all the work that's been going on with markets like Indonesia, like India, like many other parts of emerging Asia, those conversations will not end. If anything, this is the opportunity for them to escalate. Now, am I sure if our political leaders will double down and take this opportunity? I don't, but I think absolutely the opportunity is there, and our public servants have done a fabulous job of opening and keeping those doors open for us. Anonymous attendee asks, is it a good time to move from balanced fund to growth fund? The answer is going to be the same as always, which is it the right fund for you? As long as it's the right fund for you, you should be in that fund. So make sure you get advice or look at the tools to help you decide which fund you should be in, rather than trying to time the market. Anything from you, Andrew?
No, just to reiterate that there are tools on our website, there are tools on sorted.org, which should help you decide which fund you should be in.
S asks, the government is making noise about GST in KiwiSaver. How will it impact our investments? Now, Andrew, I think we just had the decision from IRD that came out last week. Is that correct, around GST on the fees charged
on fees.
Services?
Yeah, I don't think it will have any impact. If anything, from memory, Jane, our CFO, was talking about it. I think on balance, it doesn't have a major impact, particularly on KiwiSaver.
Good. I think it was really clarifying the rules of where you had to pay GST and where you didn't have to pay GST. It's not clear to me that there is a big effect in terms of the impact on that. Okay. No. Anonymous asks, order books of defense manufacturers, especially in Europe, are full for years to come. Is Simplicity considering to include these companies going forward? Is they being discussed at Simplicity at all? The answer is, I guess, no, because it's in our responsible investment guidelines, and that's our policy not to invest in these kinds of businesses.
That's right. Funny enough, last week I caught up with there was some issuers in the developing bank world, all of whom were over from Europe and the US, and had some very interesting discussions with them about them having to shift towards spending more money on defence. But no, and I think, it may possibly be an area where more money will be made, but our policy is very much that we're not going to take advantage of that.
Cool. Tony, France and Italy are the largest wine exporters to the US, $5 billion, followed by New Zealand, just under $1 billion, which is ahead of Spain, Australia, Argentina, and Chile. New Zealand at 10% tariff versus France. Italy and Spain subject to 20% tariff. This could see substitution in the US and hence New Zealand benefit. It could at the margin. The only difficulty with that is New Zealand sells really expensive wine. And so our market is actually very, very niche and quite expensive. So it could absolutely be at the margin benefit for us. And again, this is the wider story: is if the taxes on wine has gone up, will the US consumer reduce their spending on wine, or will they continue to spend the same amount? And would they buy more domestic wine producers or producers like New Zealand? So it's a bit of an open question, but again, at the margin, that relatively slower tariff makes it more affordable less expensive than others. But the starting point is our wine tends to be quite expensive on a per litre basis. Okay, Anonymous. Can you explain the effect of New Zealand dollar currency moves on investments in the US and impact on New Zealand exporters? And what is your expectation for New Zealand dollar as the trade war plays out? A partial stabilizer? I'm sorry I wasn't able to show you the slides, and that was the reason why I showed you the exchange rate, is because the New Zealand dollar has depreciated over the course of the last few years, boosting our returns for the unhedged part of our portfolio. So when the New Zealand dollar depreciates, it means that essentially it's adding to your returns in New Zealand dollar terms, that those foreign shares become worth more in New Zealand dollars. For New Zealand exporters, a depreciating currency means that our exports are more in demand, or at least we get more return for our exports. In terms of our expectation for the New Zealand dollar as the trade war plays out, could it be a partial stabilizer? It could. But the difficulty here is that because the US dollar just has been so strong over the course of the last few years, that could weaken from here, and that could actually perversely make the New Zealand dollar stronger. And the reason I'm trying to be, that one of those on one hand and on the other hand type of economist is because I've never had any success forecasting the currency. In fact, no economist does. So it is really hard to predict, but you're right. When there's very big risk events, historically, the currency has absorbed quite a lot of that shock. So that's really how the New Zealand dollar, why we have chosen for a floating exchange rate, is it gives us that cushioning effect when those big things happen around the world. Anything from you, Andrew, on that?
Nothing more really, only to say in our diversified funds, in our balanced growth and conservative funds, we hedge 50% of the global currencies and leave 50% open to currency exchange. That's in line with the major managers around the KiwiSaver market. And it also reflects, I think, the fact that exactly as you say, Shamubeel, the currency is one variable that you really find very, very hard to predict.
Now, another question from Stephen on weapons. Same answer as before. Because it's an exclusion list, we're not going to be including it in this ethical screen, right?
Yep.
Anonymous, when do you expect to see the data on the indirect tariff impact on New Zealand coming through? Well, it takes quite a long time. So the tariffs have just been announced. Not all the products that are exported today are for consumption today. So there'll be inventories that have been held in the US, and they've really been built up in the last couple of months in anticipation of these. So really, we wouldn't expect to see an impact on actual trade flows probably for another couple of months, 2-3 months. And then the flow-on effect in New Zealand might be another 2 to 3 months after that. So economists are like super tankers. They take a while to move. So yes, these things are shifting quite quickly and the headlines and financial markets are moving, but the real effect on manufacturing and exports and goods that are being produced and exported around the world, quite often they might take 3 to 6 months to flow through, both on the direct effect and the indirect. Okay, a question from Carrie. What should older retirees be doing? I.e., we have a shorter, longer term.
Yeah. Yeah, and I'm finally up with the questions now. And so, Kerry, again, we can't give you personal advice. Our tools are useful in that respect, because again, they can give you a projection of how much money you've got, how long it will last, depending on how much you want to take out of it. And as you get closer to, as you say, your long term gets shorter, then clearly you will want to preserve some or some aspect of that, assuming that that's how you prefer to go. It's such a personal thing, and I know we keep saying it. It's your personal circumstances. So my strong suggestion would be either to go and get some advice or use some of the tools to try and get a sense as to what exactly what your options are.
Eddie asks, I have only 1 year until I'm 65. I wanted to use part of my KiwiSaver to pay off my mortgage next year, but unsure how much my investment may lose. What is my best option?
Oh, yeah, I hate repeating myself so much. Really, I mean, in those circumstances, I do suggest you go and try and find somebody that will is able to give you personal advice, because that's a difficult one.
Mike asks, not sure we want to, or says, not sure we want to politicize investments. And we agree. That's why we have a passive approach to the way we invest. We do take a very kind of hands-off to view how we do these things. And that's why, again, we're quite transparent in terms of what our funds hold, what the rules are that we use to kind of include and exclude things. So by being quite hands-off and rules-based, it just means that we're not making judgments. We're kind of following what's happening in financial markets, and we focus our energy on the bits that we can control. So yeah, absolutely. We're not trying to politicize everything, because these political movements and cycles will come and they will go. Anonymous asks, if there is a big stock sell-off, will that mean that some of those billionaires who buy everything cheaply and then increase their wealth at the expense of ordinary savers, is that part of the US government plan? I don't know. It's very hard to know what the plan is in the US right now, so I won't try and speculate to answer this at this time. Are you up to the question from Karen now, Andrew?
Yeah, Karen, again, we're talking about Tesla, and I appreciate that Elon Musk is fairly polarizing, and understand that there are people who don't believe they want any exposure to shares in Tesla. It's not something we are contemplating, and I don't think we will contemplate, simply because again, our approach is to investing in index type tracking funds. Tesla's in the index, and at this stage there's no reason why it would be excluded. So we will just carry on with our current policy.
Anonymous asks, the Australian government has responded to the crisis with a big Buy Australian campaign. Should we do similar in New Zealand? Look, I think you should always kind of consume consciously, regardless of whether there is a tariff or not. The difficulty, of course, that even when we're buying New Zealand made, quite often they will have traded components, right? Because we are really kind of networked into global trade networks around the world. So my sense is that, support your local businesses, local communities. They might often be selling products that might be imported from elsewhere, but it still has a local effect because of the people that you're supporting and the people that you're interacting with. A question from Anonymous. Project 2025 dictates that the president will simply ignore the Senate, regardless of the House being Democratic or Republican. Whilst unlawful, governing by presidential executive orders is making radical policies fast and easy to implement, independent from Congress and the courts. Frankly, a dictatorship. Why do you believe the midterms will change this new status quo? Well, I don't know for sure. I guess that is the uncertainty, is will the courts be compliant or will they resist? will the midterms change? And if that happens, will that shift what happens? And I think we're just in that really uncertain environment where we just don't know how this thing unfolds. And that's really what I was trying to get across. It's not so much that I have a strong view that I can predict what's going to happen to the unfolding of the political crisis that we're seeing in the US. It's more that it's an uncertainty that adds to the broader kind of risk factors that we're talking about. Siobhan on YouTube asks, if you're a younger investor in a position to wait it out, should we try to invest more now while things are discounted? Now, that's really what Sam always talks about, right? When markets are down, everything is on sale. Now, again, we can't give personal advice, but really it's about making sure investing that's right for you. So if it's a long-term retirement savings, the thing that I always talk about is it's about the habit of savings that matters the most. Be consistent in your contributions and be persistent through your working life. That's what sets you up for success. These little bits that happen during financial market movements, they're the kind of the cream or a little bit of discount at the top and bottom. But overall, what really matters is how long you've contributed regularly over a long period of time.
Good answer.
Okay. Robin on YouTube. What's your take on Russia getting no tariffs? Well, Russia is still experiencing a whole bunch of other sanctions that had been imposed on the back of the war with Ukraine. So that's not surprising, but also read into it what you will, given the relatively positive viewing that Russia has gotten under the new administration in the US. So look, I think the end result is Russia is still quite isolated from the rest of the world because of the war in Ukraine. And so it's not surprising that there hasn't been much, because there is not much of a trade deficit with Russia and America right now. Do you want me to ask the questions?
Are we on what's your prediction of the exchange rate trend for the New Zealand dollar for the US dollar in the next
couple of months? I love that. It's like, okay, let me read it out. Given the current tariff war circumstances, what's your prediction of the exchange rate trend for the New Zealand dollar versus the US dollar in the next couple of months? Oh my God, next couple of months. I can barely tell you what's going to happen at the end of the day.
No.
Look, the currency is impossible to predict. Let's not try to predict that. So the reality is that we will have no success in predicting it. I'm not even going to try.
No, and as I said before, that we've got to the point that it's so uncertain in our view. We just have, as they say, a buck each way.
That's right.
Thank you, Tracy, for your kind words. And we do try and keep things simple. Hopefully we're continuing to do that. The next one I will answer, Shamubeel, but let me read it out. How can you claim to invest ethically when you continue to, if it's in the index, we buy it? That isn't being ethical. That is following what some other organization determines is or is not ethical. Does Simplicity actually do ethical investing, or is it entirely determined by what third-party companies claim is ethical? So if I could just explain our approach to this, we set our ethical investment policy, our responsible investment policy, and then we give that to an entity who have to perform those screens on our index. So our index is screened. Therefore, for example, if there's any fossil fuel companies, those are screened out. There's quite specific criteria. They're all in our responsible investment policy, which happy to send to anybody that can't get it online. But they're quite specific. There's revenue thresholds on companies that, for example, alcohol is another something we screen out. But there are companies, obviously, that might sell a whole load of goods and have a very small component of alcohol. They might make our investments or not. But fundamentally, the rules are set by us. We give those to an index provider, and they screen the companies out using other data to make sure that what we said we don't want to invest in, we don't invest in. And a lot of work goes in checking that those screens are being met. And we get lots of inquiry from people who think that for whatever reason, a company that we've got an investment in should be screened out or not. So ethical is not a word I particularly like. Everybody's ethics are different. However, from a responsible investment policy point of view, it's quite explicit exactly what we will and will not invest in. And so although I say it's in the index, we buy it, it's only in the index if it's not screened out by our responsible investment policy.
That's right.
Does
So
that,
I think
does that
we
make
really
sense?
do it by exclusion, don't we, Andrew? That there are
Yes.
certain types of investments that we exclude if they meet the revenue threshold. And so again, we want to be as transparent and rules-based as possible because that makes it consistent. When you're buying and selling huge amounts of stocks, you've got to be really consistent and rules-based. And so if we change the rules, then certain companies will fall in and out of it. I think that's all we can do. It's very difficult, like Andrew said, to kind of try and be consistent with everyone's ethics because they are quite different. A question from Craig on YouTube. What are China's leadership thinking about this? Is the USA isolationist stance likely to strengthen China's economy and enable them to surpass US's influence over the world? The answer is, I don't know for sure what China's leadership is thinking about this, but we know that they've been working really, really hard on essentially trying to build up strong relationships around the world in the event of the USA stepping back from I guess its trade leadership position. Will it strengthen China's economy? Probably not, because China exports so much products, both directly and indirectly to the US. Big tariffs on Chinese products and a weakness in the US economy would affect China, which is already looking pretty weak at the moment, right? Because of its other issues that it's been working through. But could it have a bigger influence on global trade? I think it could. I think in the absence of the US leadership, China will want to step into that vacuum, as will many other countries, including Europe and other places. So I think it is very much an uncertain situation. I think we might see somebody stepping into that space, but it's not clear to me that we can predict what will happen. Okay, so I think that's the end of all the question I had.
Yeah, that's quite timely. So unless anybody wants to type something in quickly now, I will thank Shamubeel very much for having to cover rather more of that than you were supposed to. Apologies that we had to scoot out of our office. But I hope it didn't interrupt things too badly. I'm sure it didn't. I'm sure you were more than capable of doing it all on your own.
Add that I think we had a little bit of trouble with some of the screen sharing on the slide. So if there was any issue, just drop us an email at our Simplicity website email, and we'll get those slides to you so you can have a look at what I was intending to speak to.
Yes, so the address is just info at simplicity.kiwi. And the team there will make sure that you get whatever you need. All right. Thank you very much, Shamubeel.
Thanks, everybody.
Thank you, everybody, for listening in.